Okay, so we're going to add some transactions today that involve the income statement, like the revenue and expense accounts. And we are continuing with the same thing we've been learning. And so it looks familiar, but we're just going to keep the knowledge we already have and build on it by adding these revenue expense transactions to what's happening. Okay, so just reiterating a little of what we had before, you notice that the notes for this chapter look very much like the chapter 2 notes, and that's just because I'm reiterating. I'm just reminding you. T accounts are very important because when you're making journal entries, it's important that you know the impact that it has on the different accounts. T accounts are a great way to be able to help you to visualize what activities are influencing this account. So for these chapters, it's important because you can see the ending balance of each account. And that way you'll know how much to put in your trial balance for each one. But as we go forward into the next unit where we talk about adjustments and closing, it's going to become even more important that you understand about T accounts and how they can track the activity and give you a picture of where you stand with that account so you'll know how to adjust it to correct. Okay, so remember that T accounts, one side is for increasing and one side is for decreasing. But no matter which account you have, the debit side is always on the left and the credit side is on the right. But now some accounts decrease with the debit and some accounts increase with the debit. And so a cash account and a dividend account and an expense account all increase with the debit, whereas the other accounts are the opposite and they increase with the credit. But we've had quite a bit of experience with that and we'll have a lot more today. But you just need to get straight in your head that the debit side of an account is on the left when you're looking at the T account. So that cash account has a debit in it right now. And that's the normal balance for cash. So you would expect that. If you had a cash account balance and you added a little more cash to it, then that would just mean you would have a bigger cash balance. As you know, we've been through this already. So, but there's not a negative and a positive connotation associated with the debit itself, because even though for the cash account, a debit's good because it means you're putting deposits in the bank. But for every debit entry, there's a corresponding credit entry. So if I record cash sales that I'm making, I increase my cash with a debit, sure, but I also increase service revenue, or also known as fees earned or fees revenue, with a credit, because revenues are recorded with the credit. So the debit and credit is just a way to record the transaction. And we have a system that works. So until someone comes up with a system that works better, this is what we continue to use in accounting. But debits in a cash account are a positive thing, yes. But in a revenue account, credits are a positive thing. So you don't put a positive and negative associated with the word debit or credit, unless you're talking about a specific account, right? So you know it's normal balance. Okay, and so then the next thing was we talked about the different kinds of accounts that fall under the asset, liability, and equities. And assets are resources the company owns. We talked about that. Liabilities are amounts that we owe. Either we owe cash or we owe a service because it's unearned revenue at this point. And then equity is the owner's share of the company. So we talked about the accounting equation, which is assets equals liabilities plus equity. And then assets, the asset total is always the exact same number as the claims total, and the claims being a combination of liabilities and equity. Under equity, you got multiple accounts. The contributed capital, which is also known as a common stock, preferred stock. We'll talk about more about those different kinds of stock in a future chapter. But for now, we're just calling it contributed capital. And when we issue stock, we're just calling it common stock for the moment. Retained earnings is just the earnings over the years that the company has earned and has kept in the company. So retained rather than paid out as dividends. So then the other things that affect equity are the revenues that the company earns during each period, and then the expenses that it costs to produce that revenue reduce the equity. So when you look at the equity section, the contributed capital, the retained earnings, and the revenue all increase with the credit because those all increase equity. But two accounts under the equity decrease equity. So when you increase expenses or you increase dividends that you're paying out, those two things decrease equity. So they are recorded with a debit. So we're going to just focus on the normal balance, which is what these are. Assets have a normal debit balance. Liabilities have a normal credit balance. And equity has a normal credit balance if it's increasing the equity. But those accounts that are contra or that decrease equity, expenses and dividends, those do not have a normal credit balance. They have a normal debit balance because it's normal for them to decrease equity, right? So that's just what we're going to do. Is the only thing that's there's some exceptions, of course, to everything. But one thing that is a little different, when you see a liability account in this group right here, it's going to normally say the words payable or unearned or due or maybe accrued. But the unearned one is the one that's hard for people to get their head around sometimes. That basically is when you collect money in advance from a customer, but you can't record it as revenue yet. So you record it instead as a liability, unearned revenue, which means you owe that customer the service that they paid you in advance for, or you owe them the goods that they paid in advance for. So we're just going to work a lot of exercises, and these include some balance sheet transactions, but also a lot of income statement transactions, which is what we're adding for this material. So this one, again, these exercises I've embedded into my lectures are from the Openstax textbook, which is a free resource. And so I have a link at the bottom of my notes that show you how to go to that if you like. These are all from chapter 3, but we'll be pulling from different chapters during the term. This one is E8, and this one's asking us to look at these accounts and determine what's the normal balance. Is it a debit or credit? So rather than looking at each one to see, I just kind of eyeballed them to say what they are. So I'm just going to talk you through this and then I'll mark the ones. Okay. So sales is a revenue account. That's a credit balance account, isn't it? So that one, I'm just going to highlight the credits. You could do either way. You could highlight the credits. You could mark the debits. Then dividends is a debit balance account. Assets, dividends, and expenses. And again, you can look at this to tell you what the normal balances are. This little chart is really a handy tool to get it straight in your head. And sometimes you can pull it back up in your memory so that you can see, oh yeah, dividends and expenses are debits too, not just assets, right? Okay. And then office supplies is an asset account. If it doesn't say the word expense and it's supplies or office supplies, they're talking about a storeroom of office supplies or supplies. So that is an asset. And then retained earnings, these dividends had a debit balance normal, and office supplies, the asset account has a normal debit. Retained earnings has a credit balance. Accounts receivable is an asset, so it is a debit balance. Prepaid rent is an account when you pay your rent for next month. You can't show it as rent expense unless it's for this current month, so you show it as prepaid rent. So that's an asset, debit balance account. Prepaid insurance, same thing. You're paying it for a future period, so it is an asset account. Wages payable is a liability, which is a credit balance account. Buildings is an asset, which is a debit balance account. And wages expense is an expense, which is a debit balance account. So the three that are credit balance accounts are sales, retained earnings, and wages. So that leaves the debit balance accounts being all the rest. I have it listed right up here, but I just so far haven't been able to get the right thing. There we go. That's just the debit balance. So this is just all the rest that aren't highlighted at the moment. Okay, so here's where there's another example similar to that. So if I were you, I would pause the video, answer what we think these are, normal balance for these accounts, and then come back to me. And whenever I tell you the answer, you'll be checking your work. So the whether it's a normal balance as a debit or credit, just step through each one of them again. Unearned revenue, we already learned, is a liability account. So that's a credit balance account. Interest expense is a debit balance account. This is an expense, and so is rent interest. So is rent expense. Those are debit balance accounts. Rent revenue is a credit balance account because it's increasing equity. So it's a credit. Accounts payable is a liability. So it's a credit. Cash is an asset. It's a debit balance account. Supplies is an asset. It's an inventory of assets. So it's an asset that is a debit balance account. Accounts payable is a liability, which is a credit balance account. That's the normal balance is credit. Equipment is a debit balance account, and utilities expense is a debit balance account. So we have 4 credit balance accounts. All the rest are debit balances. It's not that it could never go into the debit if it's a credit balance account, or it could never go into the credit if it's a debit balance account. If it's it's not that it can never go into the balance that's opposite, but if it does, it's indicating that something is wrong. So if an expense account goes into a credit balance, it means you've had to refund someone an expense that you recorded earlier. And it might mean that it's an error, that it's been recorded improperly. All right, the next one, EB11. Now this one's asking us to find out what type of entry. Identify whether ongoing transactions posted to the following accounts would normally have only debit balances, only credit entries, only debit entries, only credit entries, or both. So notes payable. When you borrow from the money from the bank, you would credit notes payable. Then when you make payments back, you would debit the notes payable when you pay principal on it. So that one would be both. Same thing with accounts receivable. When you record an accounts receivable, it's because you know the customer is about to pay you later. I'm trying to get rid of some of that space because I'm afraid I'm going to run out. I'm going to throw it on the wrong page, but I guess it'll be okay. I'll just back up just a little to get rid of that problem and then reveal these again. Okay. Utilities expense. Normally, you would never have a credit to a utility expense. It would be a debit every time because you don't normally reverse your expense entries. Same thing with sales revenue. You don't normally reverse those. It's not like accounts receivable and accounts payable. Insurance expense. Normally, you record the expenses and then you record some more expenses. So you don't have a lot of both going both ways entries in that. Dividend, same thing. You record that as a debit and you don't normally ever record a credit to dividends. Okay, this is a similar kind of problem. Indicate how changed in the following types of accounts were recorded as a debit or a credit. Asset accounts, when you increase assets, this is just talking about how does the normal balance work. If you increase assets, it's a debit, and that by its very nature indicates that a decrease would be a credit. Liability accounts increase with a credit, so decreasing it would mean it was a debit. Common stock increases with a credit, so decreasing it would be a debit. Revenue increases with a credit, so that means decreasing it is a debit. Expenses increasing with a credit with a debit, so decreasing it is a credit. So once you know how to decrease an account, you automatically know the other one because obviously it's just a reverse. So here we go again. This is the same one, same type of thing, just slightly different format. So if I were you, I'd just do this problem, pause the video, do the problem, and then check it. Equipment, this is a transaction that might happen, and how would you record it, with a debit or a credit? And the other thing you would need to know is what's the normal balance. For me, it's easier if I answer the normal balance first. So for each of these, I could just figure out what the normal balance is and then come back and decide what, if it's an increase, it was going to be going the same direction as the normal balance. If it's a decrease, it's the opposite. So the normal balance of equipment is a debit. So an increase in equipment is also a debit. And the same thing with repairs expense. The normal balance for repairs expense is a debit. So increasing it would be a debit. Then miscellaneous expense also is a normal balance of debit. So increasing it is a debit. But now here's the other ones. Dividends paid, the normal balance is a debit. So if I increase it, oh, I skipped that one. I should have done that when I was doing all the increases. So we had 4 increases this time, which is nice because that's just the normal balance. But then the decreases are the opposite. So service revenue, if it decreased, it would mean you refunded somebody something that you had sold, then it would be a debit. If bonds payable decreased, where you paid some of the principal down on the bond, that would be a debit because it's reducing the normal balance. Same thing here, except for they were sweet to us and put the normal balance first. PB7, you might want to pause and try this one. The other thing they've added on this one is they want us to say, is it, and what's the normal balance? And is it an asset, liability, or equity? And if it's an equity, then you should also write if it's a revenue or an expense. If it's not a revenue or expense, you could put just equity. All right, the normal balances, again, I like to do that part first because I can keep my train of thought. Normal balance for utilities is a debit, and for asset accounts, like accounts receivable, is a debit. Normal balance for revenue accounts is a credit. Normal balance for retained earnings is a credit. Normal balance for the asset land is a debit. Normal balance for sales and revenue is a credit. So then what account type is it? Let's see, I got to get this to go away. There we go. What account type is utility expense? Is equity, but it's a revenue account. Equity, but an expense account, sorry. Accounts receivable is an asset account. Interest revenue is an equity, but it's revenue. Retained earnings is equity. Land is an asset account. Sales revenue is equity revenue. Okay, now one thing we hadn't talked about before is when you have a collection of T accounts, that is called a ledger. Well, we might have actually talked about that in chapter 2 also. But basically the entire set of T accounts that we've done some exercises like would be called the ledger. And the ledger is just the same accounts that you would pull for your trial balance. We know what a compound entry is. We know that when you make journal entries, you list the debits first, and as the first line would be debit accounts, all the debit account entry lines would be done first, and then start the credit entry accounts. You indent the credits so it's clear to everybody that's looking at the entry that that's a credit entry. You can also skip lines between entries if you like. Okay, so this one, let me get a little sip of water. Right? The next exercise is PB8. This one's asking us to show the effect on the accounting equation with a subtraction or a plus for asset, and the same for liability, plus or minus, and for equity, plus or minus. If there's no effect from this transaction, you just put 0. So the payment of principal balance on the note, that one, you assets decreased because you paid something, liabilities decreased because you paid down on the note, and equity did not change. Purchase supplies for cash, that was no change on any count, because when you buy supplies, you're increasing a supplies asset and decreasing a cash asset. No net effect. And then the payment of dividends to stockholders is where equity is decreasing and cash is decreasing. So assets decrease, equity decrease, no change to liabilities. Issued stock for cash, that means assets increased, that cash count. Common stock increased on the equity and no change in liabilities. Billed customers for physicians services. Revenue increased. Hang in there. Try that again. Assets increased and revenue increased. No change to liabilities. Okay. Here's a couple of new concepts we haven't talked about. First, there's an assumption of periodicity, which means you break up the transactions into periods of time, like usually in years, so that you can see what happened in year one of your business versus year two. And that way you can trend and see how are we advancing? Are we improving, or are we having a slump here? Because you can tell what happened last year, the year before, 10 years ago, and it helps you to project what's going to happen in the future and strategize. Then there's the matching concept. It's also called the expense recognition concept. And that one assumes that the expenses will be reported in the period and included in the period that they help produce income, the related income. And then the revenue recognition concept assumes that the revenue is going to be recognized in the period that the goods were provided to the customer or the service was provided to the customer. So whenever the product or service was delivered, then the process is complete. Then that would be, as long as there's a sales contract in place, process is complete, and the goods are delivered, then it's time to recognize revenue, basically. That's just a generalization, but that's what the revenue recognition concept is all about. Here's some example journal entries we'll play with. We've got quite a few little sections of journal entries because it takes practice to get really comfortable with these. So if you issued stock, we've done this before, so it's nothing to it, but you debit the cash and you credit common stock. I'm just going to go in with the black on these. Okay, and then if you purchase supplies on account, you would be increasing the supplies account with a debit, and you would be increasing the accounts payable with a credit. You didn't pay for them. It would have said you bought supplies for cash. This says you purchased supplies on account, so you know you didn't give them your cash. Then the third one, billed customers for accounting services. That means you did not get the cash. If you build a customer, that's accounts receivable. $950 and sales revenue $950. Okay, the next one, it could have, instead of sales revenue, it could have said service revenue or fees revenue, fees earned. I just said sales revenue right there, which is slightly off. EA 23, post the following February transactions to T accounts. The easiest way to know you're posting transactions correctly is if you make the journal entry and then post it. But we're just going to kind of do the journal entry in our head on these so we can get them in the right account. The first one, provided legal services to customers. First, the only ones we're going to post is the ones that affect accounts receivable and cash. So the first journal entry was provided legal services to customers for cash. That means we got cash, we debited cash, and we credited the revenue account. So we're going to debit cash for that $5,600. Transaction A. Then we provided services to customers on account. Now that one means we're going to debit the accounts receivable account, but not the cash account, because we didn't collect it yet. What we did is we sold it, we're going to get it later on. So then C shows us where we collected some of the cash from the customer. That means we increased cash, and it means we decreased the accounts receivable by $3,500. If we collect cash from customer accounts, we decrease our accounts receivable. So then we could just see what is the ending result of this by tallying up. On cash account, we have 2 debits, so we're just going to have a bigger debit as the balance. It's going to be still a debit. Then on the accounts receivable, we see we have $4,700 as a debit balance, and we credited it for $3,500. So that $3,500 credit ate up some of our accounts receivable balance, leaving us with the remainder of only $1,200 as our ending balance. So we had to net it out to say what's left after we took into account the credits that were posted to that account. Then this next one, PA 18, 3 entries on the first of the month. Products were sold. These need to show their account name, don't they? Cash. we're making a T accounts for accounts receivable, sales revenue, and cash. On the first day of the month, we sold products to customers for cash. So we debit cash and we credit sales revenue. And the next transaction was we sold products to customers on account. So that means we have a debit to accounts receivable and a credit to sales revenue. And the third one was the C part was we collected cash from customers on account. So we have a debit to cash and a credit to receivables. So that's all the transactions that happen. So we can tally up and see what is the ending balance of these accounts. Cash has 2 debits. So our ending balance is just going to be a bigger debit, add them together, and that's the big ending debit balance. Sales revenue has just 2 entries, but they're credit balances. So we're just still going to combine them and make a bigger credit. So the credit total is $35,760, the total of the 2. Accounts receivable has some debits and some credits. So we're going to net them out and put them on the side of the largest, which is the debit side. We take 22,100 debit and we reduce it by the credit of 18,500, leaving us with just $3,600 left of the accounts receivable. PA 19, same kind of deal. We've got 3 transactions that affect 3 different accounts: cash, accounts payable, and inventory. The first one, we purchased inventory on account. So that means we debited inventory, we credited accounts payable for the A entry. The B entry, we paid vendors for part of the inventory we purchased earlier. So that means we credit cash when we paid the vendors. Did we pay the vendors? Maybe it's in a different place. Hang in there. Oh, look, the beginning cash had a balance of 36,500. I didn't mention that part. And we pay the creditors for accounts payable. So that means it reduced the accounts payable by the 12,000. In the C1, we purchased merchandise inventory for cash. We bought some more inventory. So it increased the inventory and we reduced the cash again to pay for it. And that's all that happened this term. So I always do the easy one first. So inventory's got 2 debits. So I take it. I'm going to tally it up and I'm going to come up with a debit balance of 26,500. Then accounts payable has debits and credits, but only 1 of each. So we're going to do it next. It's got a larger credit balance. So I know it's going to be a credit balance account, which makes sense because it's a normal credit balance account. I net them out and I wind up with, I had a $16,000 credit. I debited it by 12,000, which reduced it down to 4,000. That debit ate up some of my big old credit. And now I'm left with only 4,000 credit left. Cash has a 36,500 debit, and then we credited it for a total of 22,500. So our ending balance of cash is 14,000 left over. We got a few more. 1 more page, couple more problems. Oh, 2 more pages. Okay, PB 13. Again, this is just getting us some reps so we're more comfortable with how to record different transactions. Merchandise inventory on account, paid vendors as part of the inventory purchase, and purchase more merchandise. So I would suggest you pause this video and try this. If we were in the classroom, I would have you just work this problem, post it, and then I would solve it. So just give it a shot. And then I'm going to just reveal the answer. So revealing the answer on this one means we wind up with showing what was posted to each one. And it winds up that cash had a beginning balance and it ended up being, trying to get that to line out properly, but it's just not cooperating here. Nope. I was just trying to get it to show it as one line, but it just won't do it. Maybe it's because of this. Oh, okay. But in any case, the A transaction recorded merchandise purchase on account. So I don't see the A transaction. I think I messed up the ABC when I changed the format. Hang on just a minute. Go back here, try this again. No. I'm just trying to add the color. Okay, here we go. Now, the A transaction was recorded as a credit to accounts payable and a debit to inventory. The B transaction, a debit to cash and a credit to accounts payable. And the C transaction, a debit to inventory and a credit to cash. And then they had told you that the cash had a beginning balance of 21,220. So that allowed you to be able to calculate what is your ending balance based on this debit of 21,220 and 2 credits. So your ending balance is 99.70. Inventory has an ending balance. It's a debit of 14,650. Accounts payable has a net ending balance of a credit 3,400. Then you got the same kind of thing. You sold products to customers for cash, you sold products to customers on account, and then you collected some of the customer accounts. So take a second, see if you can get those to come out correct. And I'm going to just reveal the answers on these so we don't spend so much time wading through them. Posting A got me a debit to cash and a credit to sales revenue. Posting B got me a debit to accounts receivable and a credit to sales revenue. Posting C got me a debit to cash and a credit to accounts receivable. And then when I net each balance out, I've got cash with 2 debits, bringing me to a balance of 17,000. I've got sales revenue with 2 credits, bringing me a balance of 2150, and accounts receivable with a debit and a credit that net out to be a debit because that's the largest, and you're left with 3,150 debit. All right, just a couple more, or just one more problem actually. This is a trial balance we're going to pull. It says prepare, this is EB25, prepare an unadjusted trial balance in correct format from the alphabetized account information as follows. Assume these accounts have normal balances. That's because we already know that which accounts have debits and credit balances. So what I did when I was working on it, let's see if I can get that highlight now. I just picked out which ones were credit balances, which ones were debits first. So I put a credit beside accounts payable. I put a credit beside common stock, and I put a credit beside fees earned revenue. So that allowed me to know I'm going to take my debit accounts first in liquidity order. So I'm going to pull the cash account with a debit balance of 56,015. Then I'm going to pull the accounts receivable. I'll get this a little smaller so I can see it at the same time I'm making the entries. Accounts receivable balance, debit, and the that's all for assets. So you start with your assets in liquidity order, then you go to your liabilities, and you take accounts payable. This is the most liquid or the most coming up due the soonest, and then you take your excuse me, no other liabilities. So you start taking your common stock next, and then you don't have any retained earnings. So then you just look for the debit accounts. I'm sorry, not the debit accounts. You look for the revenue accounts first, which is fees earned revenue. So you're doing the balance sheet, assets first, then liabilities, then equity, and then the revenue accounts and the expense accounts last. So fees earned was next, and then the operating expenses. That's actually all of them. Look at them, 1, 2, 3, 4, 5, 6 accounts. So if you were doing this by hand, you would just mark off each one as you go. Like, yes, I did with that one. Now let's see if we're right. In order to be right, we have to have the debit side equal the credit side when you sum them up. So you sum up all the debits and you go with a 111,515. You sum up all the credits and you go with 111,515. So then you clap and congratulate yourself and say, yes, I conquered it. I'm a genius. This is very positive news. So that's pretty much it for this income statement one. We did a lot of examples and we're getting more and more familiar with how to do journal entries. Okay.